This is Vedant from Quantity. I will be your host today. Good morning, good afternoon, good evening. Dr. Xiao is a co-founder of Parachronic Technologies. His research interest includes more on the asset pricing, financial econometrics, investments. His research has been, featured both by Forbes and CFA Institute and institutional investors. He is on more of the editorial board as well of the Journal of Portfolio Management and Global Commodities Applied Research Digest. He received a PhD in finance from the University of Chicago, and he would be covering a topic of credit risk modeling, where he would be covering deep learning aspect, how it can be used to price and calibrate models of credit risk, and bit of deep neural networks as well for complex credit risk models, closed form solutions where it's not available. Deep learning offers of conceptually simple and very more efficient alternative solution, and more on those lines.
Well, thank you so much for having me. It's a pleasure to be here and part of the Quant Institute 10-year anniversary. Today I'll be talking about deep learning applied to credit risk modeling. This is joint work with my friend Gerardo Manzo, who's at Kepos Capital. The credit market is massive. Credit default swaps are financial contracts that allow users to exchange default risk. The CDS notional outstanding is about 8 trillion as of 2019, according to the Bank for International Settlements. Not only is the CDS market large, it's been increasing over time. The CDS index notional has grown from about 4 trillion to almost 6 trillion in the last few years. The global bond market is even larger at over $100 trillion as of 2018. And much of this is made up of corporate bonds, which of course are also exposed to credit risk since the underlying issuing institution can default on their issued bonds. As these credit markets evolve and become more complex, credit risk models, which are used to capture default risk in these markets, have also become more complex as well. We often use stochastic state variables to capture the randomness that exists in these financial markets over time and across maturity. Given that the model have become more sophisticated, estimating these models and solving them have become more complex as well and more computationally expensive. And this is a central point that we'll return to in a few slides. Machine learning has had a profound impact on many different fields of study. And likewise, in finance, machine learning is playing an increasingly bigger role. Earlier work by Hutchinson and co-authors used neural nets for derivatives pricing. But this work didn't really catch on for another 20-some years until in the past few years when machine learning has been applied in empirical finance more often, such as to cross-sectional asset pricing or to building stock portfolios. There's also developing literature on using deep learning in options pricing. Liu and co-authors approximate the Black-Scholes and the Heston models using deep learning. And there's also been some attempts to try to calibrate stochastic volatility models using deep learning. In this paper, we're going to apply deep learning to credit risk modeling. And we'll show that complex solutions of credit risk models can be replaced with their deep learning counterparts. We'll show that deep learning models can learn the mapping between model parameters, which we consider to be model inputs in the deep learning models, and credit spreads, which are outputs in these models. The deep learning models capture the credit risk models quite well, with tests at R-squares close to 100%. After we train these deep learning models, they can be used to compute credit spreads quite efficiently, about 100 to 200 times faster compared to the traditional pricing functions. We then combine deep learning with the unscented Kalman filter, which we use for calibrating credit spreads to historical data. And we achieve a high R-squared of 89 to 98%, indicating that deep learning can indeed be used to effectively calibrate these credit risk models. Now let's talk about modeling credit risk. What is the price of a defaultable bond? It's the probability weighted average of the discounted cash flows in the scenario of default and in the scenario of non-default. I see a question here about causal machine learning data model helping with time series data. I hope this becomes clear as I go through the rest of my talk. And if it's not, please ask again at the very end. Thanks. So consider that you have a $1 bond that can possibly default. So if you hold this bond and at maturity, this bond does not default, you will get the full face value of $1. And this happens with probability 1 minus the probability of default. If this bond does indeed default, you don't get the full face value. You get some recovery rate, RR. And this scenario happens with the probability of default. So everything you see here in the square brackets is the expected cash flow to this $1 bond at the time of maturity. And we have to discount that back to the present to get the current price of the bond. So as you can see, a central quantity on the previous slide is this probability of default. And when we talk about credit risk models, what these models really try to do is quantify the probability of default. There are two main types of credit risk models. Structural models seek to provide a direct link between this default event and the capital structure of an entity. And default happens when the asset value of a firm falls below the debt value. So even if you liquidate the firm and sell all its assets, you can't repay the debt. Structural models have the advantage of an attractive economic intuition built into them. But they may be difficult to implement when the underlying capital structure is complex. The alternative approach to credit risk models is the so-called reduced form models, in which default risk is modeled as a statistical process, usually some sort of Poisson process with a default intensity lambda. So the probability of default in this case is 1 minus the probability of survival, the cumulative probability, which itself is a function of this default intensity parameter. So the reduced form models are especially useful when the capital structure of the underlying entity can't be easily defined. In this paper, we'll cover several structural models, as well as a representative reduced form model of credit risk. In structural models, default is a function of the capital structure. So we have to model the capital structure. And we do so by modeling the asset growth, AG, as a stochastic process. Simpler structural models do not contain any time-varying state variables. For example, in the classic Merton 74 model, asset growth is a function of a constant volatility parameter. This is the presentation of credit risk. In more complex models of structural nature, we use time-varying state variables, such as stochastic volatility or stochastic jumps. For example, in the Heston 1993 stochastic volatility model, asset growth is a function of a time-varying volatility parameter. And we can have more complex specifications, such as 1 stochastic volatility and 1 stochastic jump, or 2 stochastic volatilities and 1 stochastic jump. We also consider one representative reduced form model in the Pan and Singleton model. And in this model, default is given by a log normal process, in which the default intensity is mean reverting and has a constant volatility parameter. Now, to use these credit risk models, we have to solve them. And for structural models, this means solving for put prices, which can then be translated into credit spreads. We need the probability of a put option finishing in the money, which can be calculated using the characteristic function of the asset value at maturity, AT. This step often requires a numerical integral, which can be computationally intensive if we're looking for high precision. For the reduced form model, we often need a grid search. For example, in the Panna-Singleton model, the authors use a fully implicit finite difference method to approximate the probability of default on a grid. So for both structural models and reduced form models, there's a trade-off between precision and speed. If we want to compute very precise credit spreads, it might take a while. And if we want to speed up the computational process, we might have to give up some precision. Gerardo and I propose a deep learning approach to this problem, in which we approximate the relationship captured in pricing functions using deep learning models. And we'll show that this deep learning approach can get around this trade-off between precision and speed and achieve both precision and speed once the model has been trained. That is, the trained deep learning models can compute credit spreads quickly and precisely. Now let's talk about, switch gears and talk about neural networks and deep learning a bit, so we can see how the two pieces of credit risk modeling and deep learning fit together. Suppose we want to predict a continuous variable y with predictors x. In linear regression, we model the outcome variable y as a linear function of the predictors x, as shown here. A neural network introduces an intermediate step with this activation function, which embeds some nonlinearity. So instead of using x to directly predict y, we'll introduce intermediate variables z's by first transforming x linearly with these alpha weights, then taking a nonlinear transformation of this. So this sigma function, this nonlinear activation function, embeds some quite simple nonlinearities actually. For example, arctangent function, or a so-called rectified linear unit, which looks like a hockey stick shape. So it's a function in which if you give it x and x is positive, you get x back. But if x is negative, you get 0 back. So we'll take the nonlinear transformation with the activation function to get these intermediate variables, which we call hidden nodes, z's. And then we'll use these hidden nodes, the intermediate variables, to then predict y in a linear form. So in this case, we introduced a intermediate layer here with a bunch of hidden nodes. So it's a single layer neural network. But we can have multiple hidden layers, first transforming x into z1s, then z2s, and so on. So we can build a deep neural network of multiple layers. M is different nodes, so we can have more than one hidden node. So just as we can have more than one predictor, x could have, let's say, 6 or 10 different predictors or columns in this matrix X. M could be 10, 20, 100, 1,000. So that's why we have M here. So here is an example of a deep neural network. At the very top here, we have the input layer of 6 different variables. So consider the matrix X on the previous slide to have 6 columns. The 6 inputs are then fed into a hidden layer of 10 units. So to answer Ramesh's question, in this case, M is equal to 10. So because we have 10 units in the first hidden layer. And then these 10 units are then passed through a second hidden layer of 6 units, a third hidden layer of 8 units, which are then used to predict the final outcome of 5 different variables in the output layer here. Think about this in a credit risk modeling setting. We have a credit risk model that has 6 model parameters. So the model parameters are the inputs here. And the model parameters are mapped through 3 hidden layers of hidden nodes, and then finally used to predict 5 credit spreads at various maturities. So think of this as a term structure of credit spreads at 5 different maturities. Now, how does deep learning learn a credit risk model? Let's first think about what a credit risk model does. Given a set of model parameters theta, once we solve the credit risk models, we can generate credit spreads. with this function fm. And this is a function, a so-called pricing function associated with the credit risk models, which provides a link between these model parameters, again, the inputs, and the credit spreads, the outputs. So when you view it this way, a pricing function, to learn this pricing function, is effectively to learn the mapping, to learn the relationship between model parameters and credit spreads. And that's a supervised learning problem we can set up, for which deep learning, of course, can be applied to. So to answer Ravi's question earlier, how do we link machine learning models with this sort of structural models of credit risk? This is how. We view the structural model of credit risk as a supervised learning problem. So deep learning can be trained to learn this pricing function, FM, in 2 steps. So given a credit risk model, M, we first simulate credit spreads or generate credit spreads for random combinations of model parameters. For example, for the Merton 74 model, the model parameters are volatility and leverage. So for the Merton 74 model, we'll draw 50,000 random parameter combinations of volatility and leverage of all possible combinations, and combine them with 5 different maturities from 1 year through 10 years to get 250,000 sets of these different model parameters. We'll then use the pricing function associated with the Merton model to calculate the credit spreads from the Merton model for these 250,000 observations. Now we have 250,000 simulated observations that have both model parameters and credit spreads. And this relationship embedded in 250,000 observations that we just simulated embeds the relationship that's captured by the pricing function for the Merton 74 model. So now we have a supervised learning problem on this data set that now we simulated. So we can train deep learning models to learn this pricing function FM and to evaluate these deep learning models on a test set. We'll use 95% of the observations, of the simulated observations for training and 5% for the test set. To train these deep learning models, we have to make some empirical choices. We just mentioned that we have, for the simulated data, for each credit risk model, we have 250,000 observations. 95% of which will be used for training and 5% for testing. The activation function we embed here is the rectified linear unit, which, as we mentioned earlier, is sort of a hockey stick shape. If you give it x and x is positive, you get x back. But if x is negative, you get 0 back. For credit risk models with different complexity, we consider slightly different deep neural network architecture. For the simpler models with no time-varying hidden state variables, we consider 2 hidden layers with 100 nodes per layer. And for the more complex models, 3 hidden layers with 100 nodes per layer. Once we've trained these deep learning models, we want to verify that the deep learning models indeed are capturing what the pricing function is capturing. So that's where the test set comes in. We want to compare the credit spreads that's produced from the trained deep learning models, or the deep neural networks, and the credit spreads from the pricing functions to verify they're the same. Here's a scatter plot for the Heston 1993 model of the credit spreads from the pricing function against the credit spreads from the deep neural networks. And this black line here, if you can see it, shows a line of perfect fit. And we see most of the data points actually line up very well on this black 45-degree line, indicating that the credit spreads generated from the deep learning models on the test sets pretty much matches the credit spreads from the pricing functions perfectly. In fact, the test set R squared here is 99.98 to 99.99, depending on the maturity of these credit spreads. But it's not just for the Heston model. The test set R squareds for all of the models that we consider are close to 100%, as you can see here. Some of them are so close that you just get numerically 1 for the R squared. And this covers a spectrum from the simplest Merton 74 structural model to the much more complex 2 stochastic volatility one stochastic jump model, which doesn't have a closed form solution for the pricing function. So these high R squares, all close to 100%, indicate that the deep learning models are indeed approximating the pricing functions almost perfectly, which means we can use deep learning models that have been trained in place of these pricing functions if we need to use them for other purposes, which we'll use them for calibration in a few slides. Once we train the deep learning models, they have a computational advantage over the pricing functions. They can compute these credit spreads much faster. Here's a table of the average time it takes to generate a full term structure of credit spreads for a random set of model parameters. Got a question about structural models have an assumption of normal distribution. How did you get over in deep neural networks? First of all, because we consider quite a broad set of structural models, not all of them embed this normal assumption. In fact, that's why we have these stochastic volatilities or stochastic jumps. That way you don't get normal anymore for your asset distribution. So in Merton, certainly you have a normal distribution. So for some of these, actually for most of these, we no longer have this normal restriction. We take the distributional assumptions in these models as given, rather than try to improve them. The goal here is not to try to get a better model, but try to approximate these models closely, and then use the approximated deep learning models in calibration, which we'll see. So why do we want to approximate these models? Because once you replace them with deep learning, you have this computational advantage. So when you look at the time it takes to generate a full term structural credit spreads for a random combination of model parameters, these are in seconds, by the way. Columns 1 through 5 are using traditional pricing functions of differing precision. 1 is the least precise, and then you get more precise as it goes to the right. 5 is the most precise and takes the longest. Column 6 is the deep learning approach. So clearly, the deep learning approach takes quite a bit less time to produce a term structure, so 5 different maturities of credit spreads compared to the traditional pricing functions. Column 7 quantifies this by taking a ratio of column 3 to column 6. So we can see the deep neural networks are about 100 to 200 times faster compared to the pricing functions. Now, you might say, well, we're talking about a fraction of a second here. So why does it matter that deep learning is a little bit faster? Well, it matters because this is only one set. This is a random set of model parameters. What if you need to do this hundreds of times for different model parameter sets? Then these fractions of a second actually add up to minutes or hours. So for these pricing functions, typically you have to run this on a server to even do a calibration. But using deep learning, we can actually do this on our personal machines. So a central goal of these credit risk models is to try to fit and understand the empirical behavior of credit spreads. And we do so through model calibration. So in a typical calibration, we think of observed spreads. So these are spreads, credit spreads you actually observe, as model spreads plus some pricing error. In this case, model spreads are generated using the pricing function FM with the model parameters. So the goal of the calibration is to find model parameters that minimize the pricing errors. Now, our proposed approach is to replace the pricing function with these trained deep learning models. So we're still thinking of actual spreads as model spreads plus pricing error, but instead of using the pricing function for model spreads, we'll use the trained deep learning models here. And with this setup, we'll use the unscented Kalman filter to try to minimize the pricing error. And we call this approach NN-UKF, for neural nets UKF. We apply our proposed approach to calibrate the Heston model and the Pan-Singleton model as representatives for the structural and reduced paradigms of credit risk modeling. We take a randomly chosen name from the North American CDS universe, which turned out to be American Express, and we try to fit the weekly CDS spreads from 2002 to 2014. This table shows the calibrated parameters as well as the R squared for these models. We can see that for the Heston model with book leverage, we get an R squared of 88.6%. For Heston with market leverage, 95% R squared. And Pan and Singleton, we achieve an R squared of 98.5%. These calibrated parameters also satisfy the model assumptions for these models. The high R squareds indicate that the deep learning models can indeed be used to calibrate models of credit risk. And as I mentioned, the main advantage here is that doing so is much faster compared to the traditional approach of using pricing functions. Here's a closer look at these calibrations. On the top here, we have the fitted CDS spreads from the calibrations plotted against the observed CDS spreads. And the dark line you see here is the line perfect fit. Most data line up on this line, but it's not perfect. And the calibrations are not perfect. We're not getting 100% R squared. And we see sort of a pattern emerging that the credit spreads that are fit most poorly are actually those that are on the shorter maturity end, 1 year or 3 year maturity credit spreads. And this is consistent with what the literature on credit risk modeling has found. On the bottom here, we have the hidden state variables associated with these models. This is the hidden default intensity of the Pan and Singleton model. And these are the hidden volatility of the Heston model with book and market leverage. And perhaps it's not surprising to see that the default intensity in the Pan and Singleton model spike during the 2008 financial crisis when the economic conditions were generally poor. And likewise, the volatility parameter, the stochastic volatility state variable of the Heston model also spike during the 2008 crisis. So to sum up, we introduced deep learning to the credit risk literature. We show that deep neural networks can learn complex credit risk models accurately and can be used to calibrate credit risk models to historical data, both quickly and accurately. Our approach offers an alternative to often numerically intensive techniques that are needed to solve these complex credit risk models, thereby making credit risk modeling easier for everybody. Thank you very much for listening. Happy to take more questions.
Thank you so much, Dr. Xiao. This has been a really great and detailed presentation. What are your predictions for the near future, COVID impact global crisis?
Yeah, that's a great question. Unfortunately, for the purpose of my work is not necessarily to make predictions about the macroeconomic environment. The purpose of these models is really to capture the credit risk modeling paradigm that is embedded in these commonly used workhorse models of credit risk. So I think for our purposes, Gerardo and I have accomplished this goal of trying to approximate these models. But unfortunately, our model cannot be used to try to forecast what will happen in the near future, whether COVID or financial crisis. But there are other models that are explicitly forecasting models, such as models trying to forecast macroeconomic conditions or forecasting recessions. I've actually done some work on forecasting recessions using machine learning as well. So those would be the models that would be suitable for making those predictions. I see a question about using root mean squared error. High R squared means relationship is linear. Yeah, so root mean squared error here will give you the same outcome, same conclusions as high R squared. So here, this is comparing two predictions. So R squared is actually quite suffice for this purpose, and root mean squared is fine as well. So we did check that RMSE is very, very small. consistent with the high R squares here. Can the deep learning model take in real-time signals to make suitable changes for prediction? Yes, this is a central goal of our paper. In fact, my co-author Gerardo is more or less a credit risk expert, and I think a motivation for doing for doing research along these lines is so that we can use these deep learning models that once they've been trained to replace the more traditional pricing functions, which means we can do calibration quite a bit faster. So you can calibrate these credit risk models intraday if you want to, because deep learning is so quick. And you can adjust your trading behavior or your other decisions based on your model output even intraday. So that's a big advantage over these traditional pricing functions. Okay, just a quick mark on Remy's comment. CDS is certainly related to economic crises, although I'm not sure what leads what, whether economic conditions get worse first or CDS spreads can be a leading indicator. Can you generate sensitivities out of deep learning? I'm not exactly sure I understand the question. If you're talking about sort of stress testing these models, I believe we have done so through looking at both training and testing. So training is sort of in sample and testing is out of sample, right? So everything I've shown you here is out of sample. So if the out of sample R squared is close to 100%, typically that means your model is pretty good. And a second way of trying to see that our models are doing what we think they're doing is when we look at the calibration exercise and the R squares are quite high and we're capturing the empirical behavior of observed CDS spreads. This means that our deep learning model indeed has captured the content embedded in these credit risk models. Using these deep learning models in a business context, well, I think a main feature of these deep learning models is their strong predictive power, which is why we thought we'd try in this credit risk setting. I haven't done this explicitly for a business context, but I will suppose that the strong predictability, there's a high probability of this transferring over as long as you're careful about how you build your model. And I'll answer the question about the best number of layers through iteration. Here, actually, what we did is quite straightforward. We actually didn't try too many combinations. We tried cross-validating and checking whether this is the best architecture. I suppose that was the question, whether 2 or 3 layers of about 100 nodes per layer is the best. We tried more nodes per layer. We tried more hidden layers, and we try to keep the model as simple as possible while still being able to capture basically the entirety of what's embedded in these credit risk models. So this is basically experiential. Out of experiments, we sort of these are sort of the simplest models that still get you about 100% out of sample R squared. All right. A simple probably default model using deep learning. I guess I still don't quite understand the question because here these are basically a bunch of different models of default risk of varying degrees of complexity, starting with the simplest and ending with something quite difficult. And it seems like the deep learning models are able to capture the behavior associated with these models, translating the inputs of model parameters into the outputs of credit spreads very well. So that is the goal of this.
Dr. Xiao, again, thank you so much. I really appreciate you giving us time, coming online and sharing all of the research with our people around. And yeah, I can see it's extremely detailed one. So really appreciate that. Thank you so much for your time, Dr. Xiao.
Well, thank you guys so much.